Good morning, and thank you for coming to our panel this morning. Clearly, Wall Street, that is to say the business of banks and brokers, have undergone dramatic change in their financial condition, their market positions, and their actual and perceived place in the economy, and as occasional instruments of social and economic policy over the last 5 to 25 years. My name is Tim O'Hara. I'm the co-head of securities at Credit Suisse, and today, with a high-powered group of leaders with wide-ranging experiences from finance and politics, we'll discuss the change over the course of their careers and where it all goes from here. So let me take a minute to introduce our participants. Congressman Richard Baker is President and CEO of the Managed Funds Association, a role he assumed in 2008 after 37 years in public office. While a member of the U.S. House of Representatives, Mr. Baker served on the House Financial Services Committee and chaired the Subcommittee on Capital Markets. Senator Evan Bayh is a senior advisor at Apollo Global Management, a partner at McGuire Woods LLC, and a lifelong public servant. Prior to his current roles, Mr. Bayh served as governor of Indiana before serving 2 terms in the U.S. Senate from 1999 through 2011, where he served on 6 prestigious committees, including the Banking Committee. Josh Friedman is co-founder, co-chairman, and co-CEO of Canyon Partners, a global alternative asset management firm with approximately $20 billion in assets under management. Prior to forming Canyon, Josh was director of capital markets for high yield and private placements at Drexel Burnham, and prior to Drexel, Josh worked in M&A at Goldman. Bennett Goodman is a senior managing director of the Blackstone Group and founder of GSO Capital Partners, a credit-oriented asset manager overseeing $50 billion in alternative credit funds. Before co-founding GSO, Bennett had been managing partner of the alternative capital division of Credit Suisse, where he had also been global head of leveraged finance. Prior to his time at Credit Suisse, Bennett had famously led the leveraged finance effort at DLJ and, like Josh, had worked at Drexel in the 1980s. Tom Joyce is chairman and CEO of Knight Capital Group. He has more than 30 years of experience in the securities industry, including a variety of leadership roles in global institutional equities, including equities e-commerce. Mr. Joyce also served on the board of the NASDAQ and currently is a fellow board member of mine on the board of SIFMA. Carey lathrop is a managing director and head of global credit markets at Citibank. After a long career at the firm, he has held positions within investment grade, high yield, emerging markets credit, and performing sales, trading, capital markets, and syndicate functions. Before I start my questions with the panelists, I'd like to review a few slides to frame some of the discussion that we'll have. As market observers, we have only to look at what the markets are saying about the securities prices of banks and brokers to conclude something has changed. As reflected in these charts, banks and financial services stocks are down 60 to 80% from their pre-crisis peaks. Funding levels for major banks, which had been competitive with the best of corporate borrowers pre-crisis, are now at multiples of the borrowing levels of their best clients. That may be one of the factors driving banks and brokers to carry less inventory than pre-crisis. This off-cited Fed data shows primary dealer securities positions, which had peaked at nearly $235 billion in September of 2007, are now, as of the latest data, down more than 80% from that figure. Management actions at banks and investor responses in the wake of the global financial crisis are clearly at work here. But another significant, some may say the most significant driver, has been changes in the regulatory regimes globally. Capital requirements are going up, and by a lot. The old Basel I and II rules required 2% core equity capital, which is represented at the bottom of this stacked bar in black, and 8% total capital. The new regime, Basel III, increases the amount of that core capital that has to be held, and then also has additional add-ons that bring the total amount of capital required at the banks up to as much as 19% when some of the in-country add-ons, like in Switzerland, which I'm pretty familiar with, are added to the total. But by any measure, a pretty significant increase in the amount of capital that's required. As those requirements come into play, for the major banks, and according to the Basel Committee, for the major banks to be in compliance, that has a requirement of either raising about $500 billion in new core equity capital. Alternatively, the banks can shrink their risk-weighted assets by about $1 trillion. And often not noticed, but also a part of the Basel III requirements, is a change in the funding composition of the banks that, if met, would actually require for the largest banks about $4 trillion in incremental funding that those banks would have to raise, which between now and the period in which that comes into effect would represent about a doubling of the normal funding requirements of those largest banks. At the same time that banks have been under pressure, and maybe to some degree because of it, the investing customers of banks and brokers have also undergone a lot of change. Bond yields, by many measures, are at or near 50-year lows, as represented in the chart on the left, which has created a lot of pressure on insurance companies and pension funds who still have to fund liability streams that were created with much higher assumed interest rates. Equities, despite a good run lately, are still only matching levels of June 2000, as shown in the chart on the right. So for many long-only investors, there has been little to no return in equities for a very long time. Long-only mutual funds have also seen little to no growth in AUM over the last 5 years. As you can see here, the long-only mutual funds are only nearing the level of assets that they had 5 years ago. And meanwhile, ETFs, leveraged mutual funds, and hedge funds have all seen significant growth in their assets under management in the last 5 years. Hedge fund assets, by Credit Suisse math, actually probably reached an all-time high in AUM at the end of the first quarter of this year. And given the potential flexibility of the business model, these market players may represent the best opportunity to replace some of the functionality of banks and brokers if, in fact, the banks and brokers cannot in every way play the roles they have for most of the last 25 years. The story is not all bad for the Wall Street firms. M&A volumes have rebounded from their post-crisis lows. 2011 saw about a 20% increase in global M&A volumes from 2009 levels. The IPO market, despite a sluggish last 3 quarters, is showing signs of life, and it's not just Facebook, though the internet does have a lot to do with it. In the first quarter, we saw more U.S. startups and venture-backed companies go public than in any other quarter since the fourth quarter of 2007. And technology and communication sector IPOs in 2011 were up more than 600% from 2008 levels. Emerging markets are another area that appears to be presenting significant opportunities. Emerging markets bond volumes reached new all-time highs in 2011, and that seems to be continuing in 2012. Our high-powered panelists will discuss all of this and more, but before we kick off our panel discussion, I want to know a little bit more about our audience and introduce you to our voting technology. You all should have received, as you came into the room, handheld voting devices. Let me emphasize, because I guess there was a problem last night where some folks left some of these meetings with the polling devices. These are intended to please be left in the room. Please don't throw them out, and please don't take them with you. They're not compatible with any other device. Just a safety warning on that. But throughout the panel, we'll be posing several multiple choice questions to the audience. It's pretty straightforward. Upon seeing the questions, just select the number or letter corresponding to your answer choice and hit the button. And so we'll give that a test run now with our first question. So I'm not sure if that's up on the screen, so I don't see it on my screen. It is? Okay. So which of the following sectors best represents your area of expertise or profession? A, financial institution, corporate, or special interest. B, nonprofit, education, or research. C, media, or D, national, state, and local government. So if you can input your answer. And I guess a note to the back, we're going to need to be able to see those results on the screen so the speakers can see as well. We're still looking at the slides up here. And we don't see them yet.
Tim.
Okay. So go ahead and vote. Tell us which one of those groups best represents you. Okay, so we're amongst friends. We have
competition.
The 4% of the national, state, and local government folks or I should say the room is 4% D. That probably underestimates the importance of that crew in this discussion we're about to have. Let's put up our next question, which is, in what region have you spent most of your professional life? A, Americas, B, Europe, Middle East, and Africa, C, Asia Pacific, and D, emerging markets. Go ahead and answer that question. And let's see the results. Okay, and I guess somewhat predictably, We do have a vast majority of folks are from here in the Americas, but a smattering of folks from around the rest of the world, which is good. We're going to talk a little bit about that as well. So let's get started with our panel. And for the first question, I'm going to start with Josh, but we'll eventually get to looking a bit forward about the business and markets. But I want to start by just getting your input on what you think are some of the largest changes that we've seen in the business of Wall Street over the last 25 years.
Okay, that's kind of a big one. I feel like you're talking to my grandfather about the changes in the auto business. It's been pretty dramatic over the last 25 or 30 years. And I've been in the business since about 1982, to give a little perspective. I'd say the first thing is an absolute explosion of financial information, which has sort of democratized the investment process. When we started in the business, or even when I went to Drexel in 1984, I think our largest client managed at the peak around $9 billion of high-yield assets, and did that with a small file room the size of a large coat closet. And the way they would get information was calling CFOs on the telephone to order 10Ks and 10Qs. And if the CFO was less than cooperative, you'd call him back 5 or 6 times. And eventually, you'd ask for permission to spend about $50 to get Edgar to FedEx you a copy of the 10K or the 10Q. Needless to say, the information you can get on your iPhone on the finance cover page is more broad. So this is pervasive, and it changes the pace of investing. It changes the information. It doesn't necessarily mean that people are any less susceptible to crowd behavior, but it certainly changes the nature of the game. And that's a huge, huge change, and it changes the whole structure of the institutions that invest. The second thing is, and I think Drexel was really at the forefront of this with Mike, was the democratization of access to capital. And it changed the structure of investment banks dramatically. The old model, there was an investment banking department, there was a trading department, they rarely spoke. Clients very rarely left one firm to go to another firm. With the integration of capital markets functions and the explosion of access to capital through the high yield and non-investment grade markets, remember, prior to that point, if you didn't have an investment grade rating and you needed capital, you either went to a commercial bank or you negotiated a private placement in a bilateral discussion with an insurance company. Within 10 years, you had an absolute explosion of vehicles for accessing capital. If you were a growing company, if you were a smaller company, and I'm not talking about venture companies, I'm talking about developed companies that didn't happen to fall into the lucky maybe 900 companies that comprise the investment grade universe. And the integration of the corporate finance function and the sales and trading markets created an absolute explosion in creativity in terms of financing instruments, and that in turn created a huge, huge proliferation of different types of vehicles other than insurance company private placement departments to finance that kind of growth. And that's a genie that never will go back in the bottle, irrespective of regulatory issues. And I guess the last one I'd say that's important is just the massive increase in the size of our large financial institutions. I think, I don't know what number employee I was when I joined Goldman Sachs, but it couldn't have been over 3,000. So it was a whole different world back then in terms of the size of these institutions and in terms of the relationship of them to the overall capital markets.
That's great. I guess, Bennett, you worked with Josh at Drexel when you guys were still pups. So you've got a perspective both from the sell side and the buy side now. Do you have anything to add to Josh's views in the last 25 years?
He was my boss when I joined Drexel, and back then, and I continue today, I say when I want to grow up in life, I want to be like Josh. So
we all had dark hair back then. I won't comment on Carey.
I'd like to have gray hair.
Let's actually let's go to Carey. I guess it's clearly that the markets have sustained an impact from some of the changes that have happened with what the Wall Street firms do and how it's impacted them. Do you have a perspective on how some of these changes in the industry have impacted the markets?
Some of the points that Josh touched on, I think are going to be continuing themes of just further disintermediation of the financial system. I think, the wholesale markets, are going to continue to grow, and you don't have to look probably any further than, I think, Europe, where, for most of our careers, you've talked about Europe moving from a banking model to more of a wholesale funding market. And I think one of the outcomes when you go a couple years forward is the LTRO is not a long-term funding